Okay, here we are with Ray Dalio, the one and only.
Hi, David.
Hi, it's great to have you, Ray. Thanks for
Great
doing
to
this.
be here.
Always enjoy speaking with you. So we all know Ray Dalio, obviously, is the founder of Bridgewater and is an esteemed author of books as well as LinkedIn posts that we all wait for. But he also now is starting something actually with Masterclass as the number one luminary investor. So congratulations.
That's how they pitch it.
Is it? Well, I think we'd all agree with that. So we have read your material and we have some sense of how you structure it, particularly in your most recent book. You've got 5 basic forces that explain a lot of economic history. You go back several hundred years and look at it. And I thought we might take some of those and apply them to the present day. And as I recall them, and you'll correct me, the first one has to do with money, credit, debt, the economy, right? And then internal conflicts within a country, external, and then forces of nature, which would be climate change probably today, and then technology. Start with the first one, the one that involves debt, credit, money, the economy, and apply it to the here and now. One of the big raging questions is, are long-term interest rates, and for this purpose I guess I mean really real interest rates, are they going to remain elevated? We're down at negative, we're now up above 1. Are they going to remain elevated in the out years as you see it, or do you think they'll come back down? There are camps in both directions at this point, and you look at the long term. Long term, where are we headed?
Well, it's most important to me to not just answer questions like higher, lower, or whatever, but to try to explain the mechanics, the cause-effect relationships that are going on, right? And the reason I did this study, which then turned into a book, and I'm just a practical markets decision maker, is that 3 big things are happening in our lifetimes that never happened before. Let me say that again. 3 things that surprise us that haven't happened in our lifetimes, but happened many times through history, are the creation of an enormous amount of debt and debt monetization. The second is the internal conflict, the large wealth gaps and the internal conflict that makes the politics of populism and so on. And the third is the great power conflict, comparable powers, the United States and China, and the possibilities of war. But back to your question in terms of the mechanics, there are very basic, simple things. That there is a debt cycle. There are short debt cycles. We're used to those. They last on average about 7 years, give or take about 3. And you have recession and interest rates are low, inflation is low, and the Federal Reserve becomes stimulative, and then you have growth, you have non-inflationary growth, and you have inflationary growth, and they tighten monetary policy, and then you have the slow up or the recession that follows until the cycle participates. It happens that way. We've had 12 of those. We're in the 13th. We're about halfway through that cycle. We're at the point where interest rates have to rise. Okay. So the level of interest rates, you have to satisfy a debtor and a creditor. And so that means interest rates have to be high enough that the creditor gets a real return, higher than their money. And if you don't do that, you create the cycle that we have before, where money is essentially free, interest rates are nil, or in some cases negative, and you have a situation where you don't have to pay principal, so money was essentially free. Then that imbalance is enormous, and it's made more enormous because even then the supply-demand is not adequate. There's not enough demand to buy those bonds, and so the Federal Reserve's got to come in there and print money and buy those bonds and redistribute wealth. So you have that. So now we have moved to a level of real interest rates. Think about inflation. That is, depending on how you calculate, if you look at tips or if you look at short-term interest rates, they need a 1 to 1.5% real rate. Those days that we have seen in the past are over, and there's a big adjustment in that. So the headline for that is, so who have been the losers? Who have been the winners and who have been the losers? This is a different kind of debt problem in that what happened is, in order to create this big transfer of wealth that there needed to be in various ways, the government borrowed a lot of money because they spent a lot more than they earned, and they sell a lot of bonds. And then the Federal Reserve buys bonds, and it subsidizes those bonds. And so the big losers of this cycle has not been the individual balance sheets, because the individual balance sheets have been improved. It is the fact that those who are holding government debt are the ones that are having the losses. So the central banks have all lost a lot of money. The commercial banks bought a lot of these debts. So when we look at the commercial banking problem, it is largely a government debt problem, because there was the financing of holding bonds with short-term interest rates, and so that was the squeeze. So you have that particular dynamic. As we move forward, the higher you raise the debt-to-income ratio, the more difficult that balancing act becomes. And so we're seeing a trade-off now that interest rates have got to be high enough for the creditor, but not too high for the debtor. And so you're seeing now this adjustment in which you're having sort of a 1%-ish growth rate, not the household sector having a problem, but those who are holding the bonds and so on, they're having the problems. And so you're seeing growth come down with still an inflation issue. The inflation issue comes from two parts, really. First of all, if you spend a lot more than you earn, and you give a lot of money in credit, you're going to have an inflation. But it also comes from the supply-demand of bonds. So if you look at who's benefiting in this, the household sector, the workers, are benefiting. This isn't a classic recession in which the unemployment rate goes up, because the unemployment rate is remaining relatively good because there's wealth transfer, and you have, and they are also having higher wage gauges. And then you have the inefficiency of the global supply chains, which happens there. So what that means, I think, is that you have this stubbornly high inflation. We're not going to go down to our targets for a number of reasons. And then there has to be the real interest rates remaining high in that. And that creates a sort of stagflation kind of environment.
So let's talk about that stubbornly high inflation. There are some who think that there are larger forces that may drive it back down. Demographics in particular, too much savings actually globally as the population ages. At the same time, reduction in productivity, less demand coming online. Some people argue, in fact, that we will have the inflation come back down on its own, and therefore the nominal rates, if you add your 1 to 1.5% on top of it for the real interest, they will come down. Do you disagree with that?
Yes. It's a matter of the amount of money and credit created, and it's also a matter of productivity. And so when we look at the amount of money and credit, we will spend a lot more than we will earn. We know the budgets, we know the projections, we know individuals. The big risk there is a supply-demand risk. So we are going to sell a lot of bonds, and then the question is, does the Federal Reserve come in and then start to print them and make that? So I think from the demand, including employment and the amount of money creation, we have that power. And then we're also living in a different world, particularly as supply chains change. The only big question is the technology impact. Like if we take a 5-year, you were talking about a longer term horizon, we'll have to talk about technology and the impact that that'll have on that in terms of productivity. But the demographics is not a favorable thing because what we're going to have to do is draw down savings, and there's going to be lesser number of population. So in terms of the labor component, I don't see that as a net positive.
You mentioned that going out, it looks like we're going to be borrowing more than we're earning. Does that mean we are in or headed for a debt crisis? You wrote a book on that as well, studying debt crises since 1945. Are we in a debt crisis, or are we headed for one?
We are in my opinion, we are at the beginning of a very classic late big cycle debt crisis, when the supply-demand gap, when you're producing too much debt, and you have also a shortage of buyers. What's happening now, as we have to sell all this debt, is we then do have enough buyers. There are changes now in terms of the quantities in the world that are being held by large investors around the world that have lost money in these treasury bonds and so on. And then there are geopolitical changes which are having an effect. Some cases, some countries are worried about sanctions, and then there's this geopolitical shift. So when I look at the supply-demand issue, there's a supply-demand issue for that debt. There's a lot of debt. It has to be bought, has to have a high enough interest rate. So a crisis, that's, if we continue down this path in terms of what's likely over the next, 5 and 10 years, then you reach the point that balancing act becomes very difficult. How
will we know? And is it really a function of not having enough buyers for the federal debt? Is there any evidence of that so far?
We're right at the brink of starting to find out that. The amount of selling of government debt collapsed, right? We didn't issue government debt. And now we're going to issue a lot of government debt. And so when we look at the buyers, there appears to be a significant shortage of the buyers for that government debt. But we're now at the brink of being able to see what that supply-demand picture looks like as we go over the next year and two.
Given the challenges that we face, fiscal challenges that you describe, we need a political process that will help us get out of it. Do we have that? It goes to the second issue that you always deal with, which is internal conflict.
Well, the things that you see happen over and over again when you look at history is when you have a financial not good situation, at the same time as you have large wealth gaps, you start to see the emergence of populism, and we see extremism in both of the political parties. Okay, we see that split. A populist is an individual or a leader or a political person who will win at all cost, that the rules of the game don't as much matter. And so we're in the January 6th type of incident and so on is very interesting. The political system in terms of primaries and the parties tends to create that sort of polarity. I think it's very clear that there is only one good outcome, if we can, and that's a strong bipartisan middle, because either of the extremes is not going to be able to be dominant. The small right, or even the small left, and as a result, we're seeing a fragmentation. Geographically, you're seeing people move to different areas, not just because of taxes, but of differences in values and so on. And so you're seeing this separation. I think over the next 2 years, the real question is, can we have a strong bipartisan middle, or are we going to have that kind of fragmentation? We have three things aligning that are concerning. On this short-term debt cycle, I call it, the 7-year cycle, we're about halfway through. In other words, interest rates are now at a level that they're probably going to stay at, but they're probably not going to rise much from here, and there's tightness. And the consequences of that are going to be a weaker economy going forward. It doesn't have to be a big downturn because of the household sector, but it is a balance sheet kind of recession. And I think things are going to get worse in the economy. There's a financial issue at the same time as you have this internal conflict. So I think that's going to make for a risky situation, particularly then when we deal with the third major influence, which is this conflict, this geopolitical conflict in the world, particularly related to China, Russia, and the implications that has on supply chains, production, and the like.
Well, let's go exactly there, because you know China very well. You've spent a lot of time there. You've invested there over the years. What do you make of the situation with the U.S. and China? You said some things that we really think we're heading in a bad direction right now.
Right now, there are irreconcilable differences on a number of topics. Taiwan, Russia, reverse CFIUS, chips, and so on. They're kind of at the edge. And that there's an inability to talk. So there's quite a bit of brinksmanship. And we are also heading into a political year here in which there's going to be more pressure. Both sides are very worried about this. So I think you're going to see restraint. I don't think it's going to lead to a terrible situation in terms of, but it is leading, you're going to see restraint in a period of time where you're going to see more tensions. There's the Mike Gallagher's commission and so on, more pressure with chips and so on and so forth. I don't think that that's going to cross the line, but it is going to raise tensions. You will see also more attempts, Tony Blinken's going over, you'll see more attempts to try to smooth things out because both sides are afraid of where we are. In any case, while it'll be that kind of brinksmanship, most likely there's a building of self-sufficiency. In other words, efficiency was the game before. Everything was global. You produce it in wherever the cheapest place was, most cost effective, and we became very intertwined with each other. Now in this global world, there's the worry about being cut off in all sorts of things. And so you're having that dynamic play, a negative role in economics and inflation.
In thinking about the U.S. relationship with China, which I think is probably the most important geopolitical economic relationship for the next generation, I would venture to say, many people have made much of the fact that China is going to overtake the United States in terms of the size of its economy, the strength of its economy. There are some questions about that now. Where are you on that question? And if, in fact, China is not as strong as we have thought it is, economically I'm talking about now, how does that affect the relationship?
I think it's almost like splitting hairs. There are two great powers, and the difference of overtake. If you take purchasing power parity, the size of GDP, they have slightly overtaken us. If you take the other, who knows? The main thing is they're comparable powers in many ways, having strengths. They can do they have a lot of dependency with each other, and they can do a lot of harm. So the most important thing, I think, is how we take care of ourselves. Can we get strong? Can we raise productivity? Can we be politically and economically cohesive so that we can be effective and strong? Because, you can't rule out China. Since I started to go to China, 1984, per capita income increased by 28 times. It's a power, and it's a smart power. So it's going to be like that. No, there's not a winner or a loser. There are only either you're going to have both winners or you're going to have both losers.
What is the route for the United States to come to a functioning relationship economically with China? Because that seems to be what people are grasping for. I mean, you could say going back to 2000 and the WTO, that was part of the theory, that China would become more like the United States, more like the West. That didn't quite work out that way. And now I think we're not quite sure how to deal with them. What is the way to have a relationship that we're going to have different systems? We're not going to agree on everything by any means, but we can really work with each other in a constructive way for the globe.
Fear. I have a saying, if you worry, you don't have to worry. And if you don't worry, you need to worry. Because if you worry, you will make sure that the thing you're worrying about doesn't happen. And right now, they're at the brink. And so the understanding of where the red lines are, and just like the Soviet Union, mutually assured destruction was the means by which we got through that. That notion of pushing each other will be just do not cross certain red lines. Chips are oil. In World War II, the United States shut off, embargoed Japanese oil, and they froze their assets, sanctions their bonds. It could be very analogous with chips and with bonds. There's worried about sanctions. Those kinds of there's a limit to being strong and then there's that issue. So I think restraint on both parties is going to be of paramount importance.
One of the things that people hope for, I would say, is some cooperation, fundamental cooperation between China and the United States when it comes to climate, to try to deal with climate issues. Your fourth element, as I recall, was acts of nature and climate. What can we do with China? And by the way, going back to your point that first we have to start with our being strong, what we should be doing on our own about climate.
There'll be probably, I would expect, some superficial cosmetic attempts at cooperation on climate. The other more contentious issues will remain simultaneously. And yes, the climate issue was very interesting. When I did this study motivated by the first three of the last 500 years, I saw that acts of nature, droughts, floods, and pandemics, toppled more civilizations, caused more deaths than any of the things I mentioned before. And so climate is certainly an issue, and we're going to see, it's not like we're going to have great surprises, though great technologies are coming, but the worst is still ahead of us. I think you know enough about that to say that this is not an easy or inexpensive problem to handle. Fortunately, there have been great advances in many sorts of technology, but it's a long and expensive way to go.
It would not be easy or inexpensive if we all agreed on how to handle it. To some extent, this gets me back to your second issue, which is internal conflict. Because right now we see, for example, how many, 17 states, something like that, are adopting legislation to restrict their pension plans for making investments based on ESG. Can we address climate as a nation? Put aside China and the rest of the world. Can we address it as a nation when we have that kind of division, political division, over even addressing the question of climate?
Right. I mean, I'm not optimistic, particularly because it's also very expensive. And so what do you do when there's so many expenses? There's the climate issue. There's the social issues, education, poverty, and school districts. My wife works in some of the, to help out in some of the worst school districts. I'll give you an example. In Connecticut, which is always 1, 2, or 3 richest states in the country, 22% of the high school students are either dropped out of high school or have absentee rates of greater than 25% and are failing classes. And there's poverty in all these. So we have so many necessities, expenditures, and problems that we cannot agree on how to handle those problems. So there's a climate component to it, but there's a bigger, more fundamental component, which is why, I mean, I'm curious, and I hope that we will see a strong bipartisan middle beat the extremes in the political situation, because it is difficult.
Let's try to end on a hopeful note here and get to your fifth issue, which is technology or invention. You mentioned it earlier. I mean, you founded Bridgewater, and from everything I've read about Bridgewater, I mean, you put a great emphasis on the systems involved, the mechanics involved, the engine. It seems to me, without knowing about it, having done this for 25 years or so, that AI might apply to that fairly easily. Is that your sense? Where are we going with artificial intelligence?
Yeah, I'm so excited because, as you say, for 25 years, I would always write down my investment principles, all my principles, and then I would convert them to algorithms, which became decision rules, which became systems, and everything would run, and they would, like setting up a computer chess game, it would play, I would play next to it, and we would then reconcile differences and we would learn together. Now what's happening with generative AI is that one can take all of that knowledge and have it there, and then go beyond that, to have it as a partner, a thought partner, because the intelligence has capacities that the human mind doesn't have. We don't, the ability to process so much and everything at the same time. So I'm extremely excited. I think that this is the greatest revolution, bigger than the internet revolution. But like technology, it really depends. The problem isn't with the technology. The problem is with the people who use the technology. Will that technology be used to raise humanity's living standards, or will that be used for war, in a sense, for hurting each other? And so, but any way we're going to cut it, if you take those 5, we're going to go through a time warp. If we take the next 5 to 10 years, in the next 5 to 10 years, it's like going to go through a time warp. We're going to come out the other side, and you're going to see a very completely different world.
I'm going to take that as hopeful. Okay, Ray Dalio, thank you so much. He's a luminary investor, but also he's the founder of Bridgewater.
Yeah, thank you.
Thanks a lot.